Welcome to this video. Today we're going to talk about Amazon. We're going to do a deep dive stock analysis in the company and answer the question whether Amazon is still a buy despite the recent stock decline of over 8%. So the stock earnings were good. We can see here that the reported earnings and the reported revenue were much higher than the estimates. However, the stock declined 8%. And in this video, we're going to find out what happened. We're going to do a business overview, whether Amazon is still a great company as an investment. And we're going to find out whether it's undervalued, overvalued by finding its true value per share based on Warren Buffett's owner's earnings. And finally, I will give my personal stock prediction based on fundamental and technical analysis. So let's get started. So here is a quick earnings overview of Q2 2025 based on their presentation. And we can see that net revenue is up 11% year on year and the net income is up 59% year on year. So the latest earnings were great. And it's interesting that despite Amazon being a massive company, they still find a way to increase their revenue and earnings each year, which is great. So if we look here on Guru Focus, we can see that even if we go many years back, we can see the revenue is increasing every year and net income is also going up. They do have a debt compared to their cash. However, if we look at the overall financial strength and the profitability rank, it's still in a pretty green, so that's great. Here is a quick business overview of Amazon. Amazon is the world's largest e-commerce and cloud provider. They consist of a few key segments: online stores, AWS, ads and subscriptions. Right now they have over 200 million Prime members globally, and they are now heavily investing in AI, automation and robotics to make the whole company more efficient to increase their earnings over time. So does Amazon have a strong economic moat? What is its competitive advantage? They have brand strength, Prime loyalty, AWS dominance, vertical integration, and they have high switching costs for AWS and ad clients. But let's go more in depth. Here we can find its true economic moat, whether it's a wide or a narrow moat. So if we press in Amazon, we can see that it is a wide moat company with an overall moat score of 8 out of 10, which is good. We can see that they have a strong cost advantage, so the ability to produce good service at lower cost than rivals. Strong network effect and efficient skill, that are the strength of the company. But there are some risks. There is a regulatory scrutiny, low margins in retail, and of course competition in cloud services from other companies, like Microsoft, for example. Is Amazon expensive or cheap? Well, based on the PE ratio, it's pretty average right now at 33 for a tech company. Microsoft is a little bit more expensive and Google is a bit more cheap. But based on this simple valuation of PE ratio and PEG ratio, it's fairly valued. But let's use a discounted cash flow method based on Warren Buffett's owner's earning. But before we do that, let's look at this quote. Jeff Bezos talks a lot about Benjamin Graham, who was the father of value investing and the mentor of Warren Buffett. And Benjamin Graham quoted that in the short run, the market is a voting machine, but in the long run, it's a weighing machine, which means that high quality companies over time will be rewarded and increase in value. This intrinsic value calculator, I filled in all the numbers using TradingView on the statements, and we are using Warren Buffett's owner's earnings. We can see here on the information what owner earnings basically is. Net income plus depreciation plus amortization plus other non-cash items minus maintenance capital expenditure. So if you fill all these in, you have the owner's earnings, and with these earnings, which is basically the money left for the stockholders, we are going to discount 20 years in the future to today's value using a growth rate and a discount rate. And then we can calculate the intrinsic value per share and find out whether this stock is cheap or expensive. So let's find out. We can see that it is slightly overvalued by 22% based on this calculator. So they say it's around 174, so let's say $175. So let's go back to the charts. Amazon is trading now at $214, and our intrinsic value was calculated at $175, which say that it's now too expensive. But I don't think the difference is too much, so we are not in a bubble right now. And if we look at the technical analysis, we can see lower lows, higher highs, and we're now looking at the weekly candles. If we look at daily candles, it's still above the 200 simple moving average. So my prediction is actually that we will go up, or we can also go first go lower and test, like maybe touch the 205, like the 50 simple moving average, or we go all the way down to make double bottom here and then go up. But I would say that the highest probability is that we will go up right away, because Amazon is a strong business. It has a strong economic moat, and they're still investing heavily in innovation, automation, AI, and robotics. And I believe that they will be able to continue to grow their earnings and net income, which will push the stock price higher eventually. However, it is not a real bargain right now. There are more cheap stocks out there with better technicals and fundamentals, but I do think that Amazon is still a great stock to have in your portfolio. I own it myself, around 4%. So like Jeff Bezos says, like great companies will be rewarded over time for the patient investor. I hope you learned something. Thank you so much for watching. Don't forget to like and subscribe, and I'll see you in the next video.